So is the world's largest economy about to move up again? I want to get the views of Charles Dumas. He's been a financial markets professional for 40 years now. And during that time, he's been an economist for General Motors as well as head of M&A for JP Morgan over in New York. And these days, he's head of international markets at Lombard Street Research with me in the studio now. Thanks so much for coming in. So when we look at these GDP figures, you're actually on the downside. You're expecting a figure closer to 1% than 2%.
Yeah, absolutely. I mean, there's the oil point, obviously, which means contribution of consumers is going to be small. And the evidence of the durable goods orders in the first quarter taken all together is that you'll get nothing out of business investment, you'll get a little bit out of inventories, but there's been a big hike in imports. So my guess is that a little over 1% maybe.
Okay, but so this will be a blip, it'll come in below what we're expecting, but you're saying that it will be a temporary hit. What happens later on in the year?
Yeah, I mean, there's a huge shape in the US economy at the moment because they have this 100% first-year write-offs for investment this year only, which means that anyone buying a truck next April had better buy it in November in order to get the tax break this year. So you're going to get a tremendous surge of the economy and led by business investment in the second half of the year. And then next year, there's a complete vacuum. Because
yeah, you're talking about a bust.
Yeah,
it'll follow immediately and drastically.
Yeah, that's right. I mean, next year, you get straight into the absence of the spending which has already happened. On top of which, you've also got an increase of Social Security tax coming through next year and Republicans baying for blood on the spending side, which means you'll certainly get some cuts on both sides of the budget. So it's very hard to see next year being anything other than pretty painful.
And what about the risk of inflation in all of this? Obviously, the Fed saying that it is temporary. We're not going to see a sustained rise in underlying inflation, but gasoline prices are rising, and we're going to see the effect of it in these figures.
Well, you know, sustained means, of course, that it passes through into wages, and it isn't passing through into wages, so I think the Fed's right.
The Fed's right. And what are your expectations with regards to unemployment?
Well, I think unemployment will come down significantly at the end of this year because of the boom I'm talking about, but it'll go back up again next year. So by the end of next year, we could be back to 9%.
And the Fed said that they're going to continue their $600 billion bond purchase plan through June. What happens after that?
Well, you know, if the businesses are beginning to push up their spending and use some of their cash for that rather than flowing it into stock buybacks and that kind of thing, that's going to create a bit of a liquidity squeeze, on top of which, as you say, the Fed's going to stop pushing cash into the market. So our feeling is that stocks stay strong through early summer. You know, this is a sell in May and go away kind of a year. And you get maybe S&P to 1400 and it's choppy at the top. And then when people see what's going to happen next year...
How low are we talking?
Oh, well, I mean, you know, once the top is passed, I would expect it to go down 20%. So you go down from 1,400 to 1,100, let's say.
Fed's also talked about rates staying low for an extended period of time. What are the risks of that?
Not very much. I mean, if they were to declare inflation to be a problem because of gas prices and so forth later in the year, then, you know, maybe you get a couple of notches, but if I'm right about the downswing next year, then they'll regret it. So I think the Fed is pushing on a piece of string at the moment. I don't think they have nearly as much power as people make out.
Why is that?
Because they've used up all their ammunition. When you start at zero and the economy fundamentally hasn't got much traction in spite of all the steroids that have been pumped into it, then you know that that monetary policy is exhausted.
Great to get your thoughts. Thank you so much, Charles Dumas of Lombard Research.